Hello and welcome to Pensions 101, a series designed to help you make sense of pensions. My name's Bat and today we're going to talk about AVC pensions. AVC stands for Additional Voluntary Contribution, and an AVC pension is a type of pension that you can build alongside your workplace pension. AVC pensions can be a tax-efficient way to boost your retirement savings. As with most pensions, AVC pensions usually qualify for tax relief from the government. Basic rate taxpayers usually get a 25% tax top-up. For example, if you paid £100 into your pension, you would get an extra £25 from the government, meaning a total of £125 will be invested into your pension pot. Higher rate taxpayers can claim further tax relief from their pension contributions through self-assessment. AVC pensions are offered by your employer or its board of trustees, and they're particularly useful if you're trying to build your retirement savings in later life, or if you have disposable income that you'd like to save efficiently. Most modern workplace pensions are defined contribution pensions. With this type of pension, the amount you'll receive in retirement depends on how much you've paid into your pension and how your investments have performed over time. If you have a defined contribution workplace pension, you won't normally need an AVC. Instead, you can simply make additional contributions directly into your workplace pension. Some older workplace pensions may be defined benefit pensions, also known as final salary schemes. They promise to pay a retirement income based on a percentage of your salary and how long you have worked for your employer. If you have a defined benefit pension, you can save extra contributions into an AVC scheme or into an added years AVC. With defined benefit pensions, an AVC works like a defined contribution pension. The value of an AVC in this case depends on how much you pay in and how your investments perform over time. With an added years AVC, the money you pay in is used to buy extra time in your defined benefit pension. This can then be used to increase your pension benefits when you retire. Added years AVCs are tied to your employer's defined benefit scheme. This means that you can only take benefits provided by your added years AVC when you start taking your defined benefit pension. If you change jobs, you can transfer your AVC pension to your new employer as long as they have a compatible scheme. If you have an added years AVC, you should speak with your employer to make sure you don't lose any valuable benefits if you transfer your savings to a different provider. Remember, pensions are an investment. As with all investments, the value of your pot can go down as well as up over time, so your capital is at risk. Thanks for watching. For more information on workplace pensions, visit our Pensions Explained Centre. Don't forget to like, share and subscribe to our YouTube channel. See you next time.